The bulls are back in town this week, and the real deal bull bear back in full force. But before we bring him in, here's Bob Pisani looking ahead to next week at the big board.
Major indices up 11% in the last 2 weeks. Can we make it 3 in a row? Two things will make the difference. Number one, earnings. Big energy companies, Exxon, Chevron, Conoco, out next week. And number two, a lot of talk on the economic front, specifically new home sales. Their hope the prices might be moderating a little bit, and we might see an improvement in sales.
All right, and joining our discussion tonight, we have Richard Sichel, Chief Investment Officer and Portfolio Manager for Philadelphia Trust. Peter Schiff with Euro Pacific Capital President. He's a bear. And still with us, we got Lee Munson, Mark Kollar, and our last gentleman who was John Buckingham. All right, so as we look at next week and the chances for some major sell-off, Peter Schiff, I realize you got a much more global view than that, but give us your view anyway. Big sell-off next week, or are people going to keep loading up?
I don't know. I don't think so. I think there's probably more legs in this move. I wouldn't be surprised to see the Dow get up to 10,000. But, I don't think that means anything about the economy. I mean, you had a 55% drop in the Dow. Markets don't go in a straight line. You're going to get bounces. But, a lot of the real value of that advance is being taken away by weakness in the dollar. The dollar index closed at a new low for the move this week.
But do you have money in this market, Peter, or not? In the U.S. stocks?
No, I have money in foreign stocks that are doing twice as good. And the difference is the long-term fundamentals are much better there. So not only do you get better valuations when you invest abroad and get higher dividends, but you're really in markets that can go up for years, not just markets that are in bear market rallies.
Right. Hey, Richard Sichel, yeah, foreign stocks are going up higher, but the Shanghai index is up, like 50%? Wouldn't you be better off going after U.S. stocks, which have not recovered nearly as much?
Well, we're more comfortable with that, and we get the foreign earnings from the Coca-Colas of the world. And, we think that corporate earnings will continue to come through better than expected. And the economic numbers are improving. Everything isn't wonderful, but, we just believe that, U.S. stocks provide good value. And when everybody's a believer, then we might think otherwise. But,
right.
We feel pretty good about the market, and the earnings will carry them.
Right. Mark Kollar, you're a bearish guy, and the bears build a very good case for things that could really come down the pike two years from now that could be very difficult. Rampant inflation, if the Fed kind of blows the way it kind of pulls off some of the trading wheels on the economy, that kind of stuff. On the other hand, you're in danger of missing out on 2-year run-up in stocks to 12,000 or something, no?
Dan, you won't see a 2-year run-up in stocks. We're anticipating actually hitting a bottom somewhere in 2010. If you look at an overlay of 1930 versus where we are now in the bear market recovery, it's almost a perfect correlation. That'll wake everybody up real quick.
Perfect correlation. Interesting, though, because it's as if, the economy hasn't changed at all since 1930. When Lee Munson, I think the economy has changed a whole lot. We're no longer centered our economy on the hydrocarbon oil atom. We're centered our economy on tech, and there's a huge difference, isn't there? Lee?
I do think there is. Absolutely. I think that, one thing that Peter was talking about, the dollar, if everything was so bad, the dollar made a new low today, but shouldn't it be a little bit lower? And I'm not really seeing this enormous sell-off in treasuries. So the Chinese keep, doing their saber rattling on they're not going to buy any more treasuries, but yet every time we see an auction, we see more foreign investors buying it. So I think a lot of the weak dollar stuff is hyped.
Look, at some point it's going to stop. They're not going to lend us money forever, especially since we're simply blowing the money on more government than consumer spending. We can't pay the money back.
They don't care what we blow it on, Peter. They care whether they get paid a good return or not.
But they're not getting any return.
If the economy goes into another tailspin, the first place they're going to go is U.S. Treasuries.
No, they have to care. You don't lend money to people who can't pay it back, and you don't lend it to governments that can't pay it back.
And we get
All
a little
we're doing
more
is printing money.
Peter Schiff,
we still have $800 billion of reserves we can't burn off.
Peter Schiff, do you really believe the U.S. government will be incapable of paying back its treasury debt?
Oh, absolutely. They can't pay it back in real purchasing power. Can they print it? Sure. But will it give any real value to our creditors? Absolutely not. In order to pay it off legitimately, they would have to dramatically increase taxes on the American public, and they're not going to do that.
John Buckingham, you want to weigh in on here? I still think the U.S. government bonds are like one of the safest instruments in the world.
Not a chance.
Well, absolutely. And, of course, we're all intertwined now globally. So I don't buy the argument that the U.S. is heading to heck in a handbasket. One of the other things to keep in mind is that stocks are still down. If you go back 2 years from now, looking at the Russell 3000 index, a broad index, you're still down 37, 38% from where you were then. So there's plenty of room to rebound here in the short run and still not be overvalued.
It doesn't mean that stocks are a good deal just because they're down from where they were. I mean, the U.S. market, even if you go back to the lows, the 2003 low, since 2003, the last 6 years, the Dow has returned about 4% a year. During the same time, the Hang Seng has returned 23% a year.
Yeah, but meanwhile, Peter, since March, Peter, the stocks are up 40%. And anybody who's terribly bearish has missed out on that entirely.
No, well, if you bought foreign stocks instead, the Hang Seng is up 90% since its lows. But, you know, if you're a market timer...
what percentage of U.S. investors, Peter, buy foreign stocks?
Not enough. I mean, all my
2%?
clients are, but...
What about the rest of us? What about people who just have retirement funds? We can't get hold of foreign stocks.
If they want to retire, they better find a way to get a hold of foreign stocks and foreign bonds because no one's going to retire on the U.S. market. Really? It's not going to deliver the purchasing power.
Too much volatility.
No, I mean, come on. I mean, we're multinational now. I mean, the whole idea that we have to buy these Chinese stocks, it reminds me a lot about in my younger days of, getting involved in these .com companies. You're dealing with companies that you don't even know.
I wasn't in the .coms.
They lie to investors.
I kept my clients out of the .coms. I'm buying value. I'm buying stocks at PEs of under 10. I'm buying dividend yields of 5 to 10%. I'm buying companies that are growing earnings at 20 to 30% a year.
In the US,
I'm not chasing tech.
But none in the U.S.?
I can't find those kind of values in the U.S. And the big problem is...
You don't think Goldman Sachs was a great value at $80 a share, Peter?
No. Well, all the money goes to the executives. Why would you want to own Goldman Sachs? All the profits go to management. They go to the traders.
Well, see,
There's
the stock
nothing
was
left
at
for the
80
shareholders.
a few months ago. And where is it now, guys? Somewhere around, what is it, 140 or something?
So, look, you're talking about short-term movements. What if it's at $40 again in a year? What if it goes to 20? What, they would have gone bankrupt if it wasn't for the government bailing everybody out.
That's where we get into this whole idea of hope versus utter hopelessness and waiting for Armageddon. And the bears seem still to be bracing for Armageddon.
I'm not waiting for Armageddon.
Dennis.
I was getting the same stuff from you guys on CNBC in 2006 and 2007 when I was talking about the stuff that was going to happen. It happened. There are a lot of bad things that are going to happen in the U.S. economy.
But the question is where it goes from here. And I didn't hear you predicting a 40% rise in stocks, Peter.
Look, I own stocks. I own foreign stocks. I am not trying to give short-term predictions on market movements. Long-term, this is a bear market. I mean, look at all the bear market rallies we had during the 1970s. Meanwhile, there's a lot of inflation.
And they're great to play. You can almost double your money.
Dennis, the entire economy runs on debt.
You're going to have to do a lot more than double your money to break even on a rising cost of living.
Which gentleman was saying Dennis?
Dennis, right here.
Inflation.
Yeah, who said Dennis? Go ahead.
In Chicago, the entire U.S. economy relies on loans and debt. End of story. Now, what we're seeing in the trenches are people coming in our office with hundreds of thousands of dollars on their lines of credit being taken. We're seeing, people getting laid off.
Yeah, I know, but you know what? I've heard that story for months now, and I think what we're really seeing is that the worst is over, man. The worst truly is over, at least for a little while.
Maybe a little while,
That's my story.
Dennis,
I'm sticking to it, and now I got to wrap. Thank you very much, gentlemen.